Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Tuesday, October 31st, 2023. At our top story today, Foundation investment performance trails for the third quarter. And joining me now to discuss this and a lot more, John Seitz is the founder of FoundationMark. John, always great to see you. Thanks so much for joining us on the program this morning.
Well, thanks for having me, Jeff. It's always a pleasure.
And look, I love talking about the not-for-profit arena. We're going to talk about colleges in the second, college endowments in the second segment, but let's talk about foundations. And I know you and the team do a lot of research each and every quarter on how foundations performed. Let's get into it. Let's talk about third quarter performance. How did these foundations we're talking about, like, the foundations like the Gates Foundation, the Ford's Foundation, these are huge, long existing foundations. How did they perform in Q3?
It wasn't a great quarter. The foundations were down 2.9% in the third quarter, and that brings year-to-date gains back to 8.2% on an investment point of view. Their assets are actually up about 5%. And the distinction between those numbers are that foundations are continually giving money away. That's their reason for being. They have to give away at least 5% of their assets. So they're always, going up a hill, and that hill is always very steep. It's not just a pot of money that can grow and grow. It's got to be paid out in installments.
And in terms of, I want to get to the giving in a second, but in terms of the asset allocation, and I know it's the same thing with retirement plans and pensions. Every asset pool is very different from the other asset pool. But are there some consistencies that you and the team have seen in terms of asset allocation for these, maybe on the larger end of the foundations?
Yeah. Great question, because what you've seen over the last 10 years is an increasing use of alternative assets, private equity, hedge funds, and other partnerships like that, which, have performed very well for the last, let's say, 20 years. But the last 2 years have been challenging for the alternative space. But the overall allocation, I'd say there were two trends. One is the allocation to cash and fixed income. Again, that has been drifting down for a long time, from about over 20% of assets 10 years ago to only about 15%, and even lower in terms of the larger foundations that you point out. And one of the things that actually was a bit of a benefit from that point of view was in the last year, high grade bonds, the Barclays Bloomberg Aggregate Index has really come under a lot of pressure. So any portfolio that had a large exposure to high grade bonds, probably took they had a very challenging time. And so that's one of the benefits of having a relatively lower exposure to cash and fixed income.
And John, in the asset management world, usually 60-40 is the traditional asset allocation, and use that a lot of times, to benchmark a plan. How do these foundations stack up against I'll call it traditional? Is it really traditional anymore? The standard, the traditional 60-40, because not everyone does that anymore. But it's kind of old school.
I think it's an excellent default position, right? Which is, what would, again, it's very easy to create a 60-40 portfolio and measure against that, especially over long periods, because some of these asset classes just didn't really exist, or exist in the size that they do 10 or 15 years ago. But anyway, the 60/40 portfolio was it was up about sorry, I'm trying to remember this right there. It was up, well, foundations were up 8.2 year to date, and foundations were doing a little bit better than the 60/40 portfolio. But I'm sorry, yeah, there's the 60/40 was up 7.2%. So foundations did a little bit better. And a lot of that was attributable to their lower exposure to the fixed income markets. So that has been a benefit. Over the longer term, foundations have not kept up with the 60/40, despite their large allocation to equity and equity-linked products like private equity and hedge funds.
That surprises me. I guess. Is there any reason or cause for why they wouldn't? Because these are long-term investments, right? I mean, they have to give away 5%, but any thoughts as to why that would not be the case? Maybe that just kind of where they allocate their money is a little bit different.
Yeah. Well, I think one of it is that over the last 10 years, again, we've really seen great outperformance from the technology sector and sort of high octane stocks. And you can imagine some foundations who are in equities, but they might have more conservative portfolios. Is one reason. The other reason is there probably isn't as much pressure put on the managers, because a lot of not the larger ones, but we do feel that there are a lot of foundations that aren't as actively managed in terms of if it's your money, you get very concerned about it. But if it's in a foundation and that's money that's just going to charity at some point, and they don't revisit it quite as often as they should. And we think that that's actually a very big problem that exists in the foundation world, and one that we'd really like to shine a light on.
Well, John, it sounds like it's almost like that set it and forget it, that Ron Popeil style of management, although he was more selling you how to bake something. Anyway, it doesn't matter. What does this all mean for giving? Because at the end of the day, these foundations, as you said, are set up to give away money. Ford Foundation, talked about the Gates Foundation. I mean, there are gazillions of these things, but they're set up to help other not-for-profits, other charities, other charitable causes. What does this ultimately mean, or what did this ultimately mean for giving?
It's got huge implications, because the foundations, in terms of total giving in the United States, represents about 19% of total giving, and that number has been going up as individual giving has been coming down and corporate giving has been coming down. So the more money that foundations have, then the more that they can give away. And foundation assets peaked actually, at the end of December in 2021, and they're down about 10% from that peak. So the implications for giving are that it takes a little while, because foundations usually use a 3-year rolling average to set their giving trends. But we're looking at giving to be up very small this year if markets stay where they are. If markets fall, which beginning of this quarter doesn't seem to be a very helpful start. But if markets fall, then we might see giving flat or even down. And then when you look forward to 2024, it might be a rockier time unless we see a rebound in the equity markets. As I said, it's mostly tied to the equity markets because their exposure there is nearly 80%.
Yeah, and like I said, I mean, this has so many societal impacts. You think about all the all the smaller not-for-profits that women's organizations, food preparation for people who can't afford food. I just think about some of those, and there are dozens of others. So I guess we'll have to see how it all kind of pans out. John, I need to take a very quick break. When we come back, we're going to switch gears, talk about college endowments. John's got some good insight. You're going to want to stay tuned right here. on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Well, John, thanks so much for staying with us. Really appreciate you hanging around for segment number 2 this morning.
Of course.
And from one pool of assets to another, let's switch gears, talk about college endowments, John. College has been in the news, obviously very important. A lot of people going back to school either as retirees or first-time college attendees, as young kids. How did those endowments do, though?
So, college endowments are their fiscal year ends in June 30, as you can imagine the academic calendar. So we're starting to get those results because here it's October and then close the books, and the large colleges are really not doing as well as they should. The average college, according to Cambridge, was up about 6.9% for the year. So that's June to June. Versus, again, we were just talking about the 60-40, and over that period, that was up 11.2%. So colleges overall really underperformed in their fiscal 2023.
And what did it mean when you look? We talked about the asset allocation in the foundation world. What about the asset allocation? Do you have any idea about the foundations, the endowment, how they're allocating? Are they heavily weighted towards alternatives as well, or do they follow more of a 60-40 split? Again, painting with a broad brush. We know that every asset pool is different, unique. I get that.
Well, the college endowments are if you look at the entirety of their pool of assets, are much more heavily weighted to alternatives. I mean, famously, Yale only has 3% of their $30 billion endowment in public equities, and outsized allocations to venture capital and to other private equity vehicles. And it's really that allocation to venture capital that is causing these results to be, again, well below the 60-40. And when you look at, as I said, the overall college endowment market, according to Cambridge, was 6.9%. But when you look at some of the big names out there, MIT was down 2.9%, Duke was down 1%, Harvard was up 2.9%. But you're hearing down small, up small, nowhere near the 11.2%. Nobody was, none of the big foundations big endowments were up anywhere close to the 60-40. Even Yale, again, the long-term benchmark was up 1.8%. So these numbers are not good. And following a not good 2022, remember. And so there's always talk about, is the endowment model broken? This definitely gives a little more credence to that argument. And we didn't really start to talk about it, but this could have a liquidity implication. If the M&A and IPO markets stay where they are now.
Yeah, and let's get back to that in a second. But these endowments, so endowments typically for colleges, universities, my understanding is maybe they're used for capital improvements, maybe they're used to underwrite scholarships for students, and they're used for other expenditures. What does this mean? Does this mean that there's less capital available to build that new science building, or I'm not going to say the new football field, because that, even though that's probably paid for by other donors. But what does ultimately this mean? This decrease in and poorer performance for endowments? Does this mean less spend for 2024 and 2025 in terms of the student population?
Yeah. So a college like Yale, the endowment supports about 30% of their total operating costs. So it's in big numbers, and there's that fact, which is if the endowment goes down and their ongoing contributions to the operating costs of the college go down, then that obviously leaves a gap that the college is going to have to fund, whether or not it's in scholarships or anything like that. And then on top of that, you've got inflationary effects. So if you're running a college, and you're heating your dorms and you're got your cafeteria running, and all these other costs that we as consumers know about, so it could lead to pressures on scholarships. There might not just be as much money as available as there had been in past years, or as you point out, to the physical plant and or faculty raises, or all the other things that go into the operating costs of an education institution.
Yeah, and John, just to circle back, you mentioned the venture and the IPO M&A market. How does that have an impact on what we're talking about? So I think you mentioned, I think it was Yale had a significant allocation to venture. If there's no IPOs or less than normal IPOs, maybe that has a significant drag on the portfolio.
It can. I mean, it can be. I mean, we saw this really in 2008, most markedly, which was as your public equity markets, came down, and your private markets, basically the way that you get money out of private equity is you sell your private companies either into the open market in the IPO, or you sell it on to some other financial buyer, whether or not that's a company or another private equity company. But M&A is down 40% this year. But anyway, those are the liquidity events. So if you are invested in private equity and you don't have these liquidity events, then you've got to turn to your liquid assets that you can sell, like, again, public equities, fixed income products, things like that you can sell in order to pay your 5% required, in order to remain tax exempt, you need to pay out 5%, whether or not it's a college or a foundation. That's the deal. And so, yeah, you could see, that's pressure, coming on, and then that pushes your asset allocation even worse, because if you have big allocation to venture capital, for example, and it's illiquid, and then you have to sell your liquid stuff, then you just push up the overall percentage of that, and then it could be you can get into trouble if you're not if you don't have enough liquidity.
Yeah, well, it goes to show you. I mean, I think the American people on the individual level are having some challenges, and these large asset pools, they have challenges as well, and everyone's trying to meet those challenges. John, very, very informative information. Great seeing you as always. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Thanks, Jeff. It's been a pleasure. It's always great to see you and to talk to your subscribers.
And that wraps up this episode of BRNAM. Have a topic of interest, someone you think we should talk to? Well, then drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Well, then you better visit our website. We're back again tomorrow with another edition of BRNAM. We'll have a very special guest. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.